Bitcoin smashes through 93, although it's a little below that now. Is this rally continuing? What's going on in the markets? And what's up with new stablecoin issuers using their own blockchains? We're going to unpack all this and more with Noel Atchison right now. Let's go.
Let's go.
Well, good morning, everyone. As you can tell, it's Dave Weisberger here. Sorry, Scott is still indisposed this week. He'll be back next Monday, I think. But for now, welcome, Noel. Lots going on in the world of crypto today.
Dave, so good to see you. Thank you so much for having me today. And, let's get Scott back soon. But I can't think of anyone I'd rather talk to today than you.
So, I want to start with, everyone's, favorite topic, which is, the vagaries of price action. And I say it that way because you and I look at the macro a lot. You, in fact, for those who don't know, are the writer of the Crypto is Macro newsletter, one of my favorite morning reads, which came out a half hour before the show, this morning again. And, we always talk about, what's happening in the world versus crypto. And you confessed this morning that you were a little surprised by yesterday. And I'm just curious, what are you thinking and what are you seeing on the macro side? What's going on here?
One of the many reasons I'd probably make a terrible trader is that yesterday I wrote that we will probably see some bounce, but not a very noticeable one. And then I wake up this morning and we're back up to 93, which is definitely good for spirits. Not going to say no to that. However, to put things into context, we're pretty much where we were a week ago before the weekend slump. So it's not time to ring out the confetti just yet. That said, it was encouraging. I'm very puzzled as to why we're seeing some movement on rates expectations. I'm very puzzled as to why we're seeing that too. That's a different story. We know, and I know that you talked about this often, that Bitcoin is the leading indicator for rates expectations, and that's the main driver for Bitcoin price these days. I would have thought with President Trump announcing yesterday that he's not going to let us know his Fed chair nomination pick until next year, I would have thought the delay would have made traders nervous. It seems to have done the opposite because there's some movement on expectations for a rate cut in January. There had been no expectation at all. Now there's not much of one, but certainly more than there was just a couple of days ago. In other words, a very strange reaction to this delay, but it does support my hunch that the Bitcoin move is more about rates expectations still than it is about the Vanguard house finally authorizing access to crypto spots. I'd be surprised if the inflows are so strong as to move the Bitcoin price this much.
Well, I'm not sure I agree. I think that right now we're under 92 again. So, whatever. I mean, markets move around a lot, particularly there's generally a downdraft right before and through the US Open, which happens in 24 minutes. So, things move around. But understand a few things. First, Bitcoin is a really interesting asset insofar as the price setter in Bitcoin tends to be short-term traders because there's about 5 times more volume in the perpetual swap markets than there is in the spot market, except that the sustained rally that we saw most of this year came from the spot side where people buying Bitcoin and the perpetual spot markets reacting to that. So it sets up this thing where this kind of dynamic that the perpetual swap markets can take markets up or down on the weekend where without necessarily changing spot demand. And when that happens, then it starts to reverse on Monday or Tuesday. And so I think that's what we saw. I think we saw the perpetual spot market and speculators taking the market down, and it's reversing. But we'll see where the real trend is that comes after that. My suspicion is that we're approaching seller's exhaustion. Pretty much every, I hate the word KOL, key opinion leaders in crypto, because most of them aren't worth shit. I don't care how many followers they have. You get flighty people making all sorts of interesting conversations. And, it's like they always tell you, this is true. Anytime you see a KOL who's ever deleted a tweet or a post, you should immediately unsubscribe and never follow them again, because what they're doing is they're saying, unlike you, who has a daily newsletter, which is a record of what you think, they're basically letting you create a record that shows only their good predictions, not their bad ones. And that's a really dangerous scenario, and there are quite a few of them that do it. And so I like bookmarking a bunch of tweets, a bunch of posts that I see, and when I see them go away, it's like, okay, put that one in the notebook. But most of them went bearish. I mean, pretty much all of them went bearish over the last 3 weeks, and the sentiment got to absolute levels that we actually, in the number went below where it was after FTX. Now, after FTX, there was a wipeout of ridiculous proportions. I mean, at CoinRoutes, we saw literally half our customers go bankrupt. Not from us, obviously, but they had money on FTX. I mean, that's just crazy numbers. And 3/4 of them stopped trading entirely for several months. But we didn't see that after October 10th because, of course, it wasn't nearly as bad. People didn't lose assets being held. Trading losses are not as bad as losing assets. But the sentiment got that bad. And so it's hard to think, where all bear markets happen because of selling, and generally bull markets happen when the sentiment is the worst. And so we'll see what happens. I'm not breaking out the confetti. I think it's a great sentence, but I think that market price can often move without the narrative that people are looking for. Now, the narratives, however, are important in the long term. And so that's what's important. So, whether it's asset or not, and I think it probably will be, one thing we do know is the direction of rates is down and liquidity is up over the next 6 to 8 months. We know that, right?
Yeah, or even longer. I mean, you and I have often debated this before. There's the short-term thesis, there's the long-term thesis, and there the twain shall meet kind of thing. Short-term thesis is going to be very volatile coming in. Pushing back a bit on your sentiment thing, I would argue that sentiment used to be crypto native. That's what mattered. Now sentiment is no longer just crypto native. We're seeing Bitcoin, ETH to a lesser extent, act as macro assets. One thing that we've seen since the beginning of November that I've never seen before in crypto markets is crypto prices falling and falling hard, but Bitcoin and ETH dominance also falling, which suggests that Bitcoin and ETH are underperforming some of the riskier crypto assets in a down market. I mean, you and I know that that's not normal for crypto, but what we were looking at was proof that crypto is now macro. And what we were seeing was not a rotation into the safe assets of Bitcoin and ETH as we normally do. We were seeing a rotation out of crypto, period, into macro assets. And so when it comes to the new money coming in that we're waiting for, with the sentiment as bad as it is, it's going to be macro money. And where's that going to come from and why? I think the main question also is, why? Is there any reason for new money to come into the market between now and the end of the year? I don't really see it, especially when professional investors don't have the luxury of long-term horizons like you or I would do in our personal portfolios. They have to report, especially now that we're coming out to end of year. Maybe they just don't want to have the conversation about why they are holding an asset that has notably underperformed pretty much every other macro asset so far this year. So there could be more selling ahead as we head into that window dressing period. There's also tax loss harvesting to take into account. Even if we reach the floor again at 80, though, I don't see it going much lower than that. I don't see much reason for it to soar above 100, though.
Whoops, sorry. Evidently, I had pushed the mute on my microphone. So let's start this again.
I was looking at my settings. Is it me?
Yeah, you're looking at me. No. You can hear me now, right?
Yes,
Yeah,
perfect.
yeah. I hate having to say on one of these streams. Can you hear me?
Yeah,
I actually disagree with you. I think there are two pieces of news that matter. Vanguard isn't as important for the flows as people think, because the brokerage part of Vanguard, I mean, they're not small, but they're not huge either. Vanguard is a fund company. where they're the largest and cheapest S&P 500 mutual fund, total market fund, a lot of other funds. Vanguard funds tend to be the lowest management fees in the business, which is of course why they've attracted so much money. But as a signal that Bitcoin is a asset that is ownable and one that you can talk to without career risk, it is extraordinarily important. Couple that with Bank of America telling people that you can put in your accounts, and for all their financial advisors, remember, Bank of America is Merrill Lynch, for those who don't remember. So you have 15,000 financial advisors who were now cleared to recommend putting 1 to 4% of people's portfolios into Bitcoin ETFs. That is not a small thing. That's actually a huge thing. And frankly, people in financial markets understand the story. The story that the people who have little gray beards like me are talking about to their clients is that Bitcoin is a potential digital gold with a 10x on it if you hold for the long term. So these small to short-term price moves actually make it more attractive, not less attractive, because it's a better entry price. So I don't think that the short-term price drawdown matters. And frankly, it's down, 6% on the year? So unless you have clients who bought in the short term at 126 that are going to sell and hope to buy back in a month later, because remember, in the US, if you sell an ETF, you have to wait 30 days to buy for the tax loss. Now, will they play clever games? It is possible to see people selling IBIT and buying BITB or vice versa. And maybe the IRS isn't smart enough to know that they're the same asset, and so not calling that a wash sale. I am not a tax advisor. I am not an attorney. I do not want to give anyone advice. I have no idea. I think that's kind of a dangerous game to play, even if it's strictly legal, because the IRS could come out with interpretive guidance. I never want to screw around with the tax authorities, but there could be something there. But even there, that would be net flat to Bitcoin, so it wouldn't matter. So I think those two things will cause flows into the year end that do matter. And it's the kind of thing that does matter for long-term price formation. So I kind of disagree with you there.
I hope you're right. I mean, seriously, obviously, for everyone's sake, I really hope you're right. I'm bullish Bitcoin, but not short-term for the reasons I've explained. It's a macro asset, and fund managers, as you know, they've got their reputations to care about, and explaining to clients why Bitcoin is on there when they could have been in gold instead is going to be hard. But you're so right, and about the messaging, Vanguard moving and changing their minds on the crypto ban that they had is huge. That I think the Bank of America is actually even a bigger deal, because 4% is a lot. I mean, remember, it wasn't that long ago that 1% was considered extremely risky. And then, of course, you also have the BlackRock messaging, which is coming thick and fast, not just about crypto, but about tokenization generally, which is going to implant the idea into pretty much everyone's mind that they have to at least have some participation in the crypto ecosystem, because it is just getting started. But again, short term, it comes down to the timing, and end of year is a macro game. Next year, totally different. Rates, liquidity issues, global liquidity issues as well. I was reading this morning about the bank reform, the reform to the capital reserve requirements that Governor Michelle Bowman is talking about. She was in Madrid last month actually talking about this, which they didn't invite me to that event, but I did think it was fascinating. This, I know, I'm sure the invitation got lost in the post. It's being very overlooked in the liquidity story, because if indeed the capital requirements are reduced, the Financial Times this morning was estimating that could unleash something like $140 billion of new liquidity into the market just by tweaking a ratio.
Well, that's been speculated many times. Look, there's a lot of stress in the, and I'm sure you'll write about CDS spreads and bankruptcies at some point in the near future if you haven't recently. But there's a lot of stresses in the economy, and if you're sitting at the Federal Reserve, you know that. Now, the last thing they're going to ever do is tell people, "Oh, there's stresses in the economy." The job of the Fed and the Treasury is to talk up the economy, while behind the scenes do the things to keep it flowing along. But when you have an economy that is so K-shaped, and everyone loves that word now, so we'll use it because everyone's there. What does that mean? Well, it means that the aggregate GDP is humming along, because there's this whole new industrial revolution going on with AI, and it requires, and people who call it a bubble are just literally asleep at the switch. There are people who think, oh, history is repeating, and they're just, I mean, I don't want to, I'll use the word ignorant, because they're not actually looking at the amount of power, at the amount of infrastructure required to upgrade grids around the world, certainly in the United States. They're not understanding data center capacity and compute and chips and all the things that go into it. But make no mistake, this is the next industrial revolution, right? There's a huge change. And in marked contrast to the internet, that started in the 90s, that caused the internet bubble that then, receded. But if you look at it, a few things are true. First of all, in 1999, we were using 5%. Yes, that's the number. 5% of the total internet capacity, of telco capacity, because they were building an enormous amount, Global Crossing, WorldCom. They got huge amounts of money, and they built out capacity well beyond what anybody or any peak demand was. So of course, when you're using so little of it, what happened? Well, the revenues never caught up to the expense, and companies went kaboom. And so the internet bubble was, part of it was pricked by the fact that Cisco was this huge monster, because they were dominant in switching. They were dominant in routing. Sound familiar to another company, right? Totally dominant. And they were the first company. They were the big, went from, a smallish kind of medium tech company to bigger than the giants and the biggest. And of course, at 5% utilization, at a certain point, people stopped buying their routers, or it slowed down dramatically. And so the stock pinwheeled down. Well, the difference today, NVIDIA might lose their chip lead in terms of technology if the Teslas of the world and other people of the world really do build their own chips, and there is there is competition in tech. But we are massively under capacity. We do not have nearly enough chips, nearly enough compute power, nearly enough power to satisfy even the big three AI models, much less all the competitors that are coming out with specialized models. So, you have, obviously there's Grok and ChatGPT and Anthropic, and there are others, of course. But there's a ton. There's at least a dozen specialty models that are being built in verticals where there's huge demand. Think of law and medical are two massive sources. Think about libraries, right? Librarians. I mean, just think about all the research assistants in anytime there's a research assistant, you're going to effectively replace that with AI, or augment it and make the person more productive by AI. So think about that.
Yeah, I'll layer on two other things onto that. I mean, I agree with what you say. I'm skeptical the prices are warranted, but again, that's not really the issue. I live in Europe, as you know, and here we also have the flood coming from military spending. We're going to have to jack up spending, a lot more than is even in the budgets today. And there's no option. There's just no option to not do that. So the liquidity is coming one way or another. I'm going to throw in a different tack, though, and that is, it's not really the price of the AI plays or even their expected utility, whether it's justified or not. Can the stock market go down? We're in an entirely different environment now than we were in 2000 in terms of the relevance of the stock market for people's 401ks, for all sorts of benchmarks that determine overall liquidity in the market. It's one of the largest factors in financial conditions, for instance, where the stock market to go down, that would dry up, which would have a whole cascade of unfortunate events, and there are midterms coming up. And then after that, there's an election coming up. And so it's just not going to be allowed to happen. I used to laugh at that statement. I used to think, oh, don't be silly. The government could not stop the market correcting 20% if indeed traders exited en masse. But then I realized what I was missing was that it becomes self-perpetuating. If everyone is assuming it's not going to fall, then there's no reason to exit en masse. The only reason to do so would be to doubt the government's conviction in not letting it fall.
Yeah, I mean, I hate that. I mean, I'm telling you, it's of all the narratives that are out there in the market, it's the one I hate the most, but I grudgingly have to agree. I mean, Mike McGlone and I talk about this. It's one of the areas we agree on. This administration for sure is fixated on the stock market, but even if they wasn't, you're right. the fact is the wealth effect is what's propping up consumer demand. And so they care about financial assets. I actually responded, because I often do sometimes, to like Bernie Sanders, because Bernie Sanders wrote his typical moronic tweet about how there shouldn't be billionaires or oligarchs and whatnot. And I basically said, listen, bipartisan, both parties have had a policy of spending more than they should, and it accelerated under Biden, and that's why assets have gone up, because once again both parties have had a policy where, to the extent there's inflation, it should be diverted into assets as opposed to consumer goods. Now, how do you do that? You do that by keeping interest rates below where markets would normally do. So you make investment more attractive, and that creates more assets. You also put a regulatory regime involved, which makes it harder for non-public or non-asset-based companies to compete with the larger companies. And that of course, by the way, is very bad for the average person. That's something where Bernie doesn't want to get involved in that, because his party wants more regulation, and that regulation tends to exacerbate and make the oligarchs more powerful, because guess who writes the regulations? It's exactly the oligopolies in charge of every industry. So if you want to know who writes the pharma regulation, it's pharma. You want to know who writes the food regulation? It's the big food companies. Who writes the agricultural regulation? It's big agriculture. It's not family farms that are doing that. You want to know who writes banking? It's JP Morgan and their cronies. This is what happens. And so, and the reason I'm pointing this out is because this is bipartisan. People worry about, oh my God, if the Democrats win the midterms, how bad that will be. Well, look, as a human, I think it'll be horrible, because for 2 years, all we'll hear about is impeachment and nothing will get done. But there's an old statement on Wall Street: markets love gridlock. Why? Because it means the government won't screw anything up. And so I'm not at all certain that it's a bad thing for markets or assets, because I think it's bipartisan. It really, what matters is liquidity. And when we talk about liquidity, just to be really clear, we're talking about money that needs to go somewhere. And when that money goes somewhere, what happens in the world when interest rates are coming down? It gets pushed out on the risk curve. Right out, boom. And so now all of a sudden, what are you buying? If you can't get money, can't get interest from your 5% in treasuries, well, people are going to buy more risky bonds. They're going to buy equities. They're going to buy Bitcoin. They're going to buy crypto. They're going to buy whatever. But what they're not going to do is leave it in an interest-bearing account or in treasuries that are paying 1 or 2% when they used to get 5%, because it's not enough. That's the biggest difference.
And this is something the regulators are now understanding, now that we don't have Gensler at the SEC anymore. I was listening to his comments the other day about how crypto is still risk, except Bitcoin. Which is crazy, because Bitcoin is risky, let's face it. But what they've never understood is that people want risk, and people will find it if there isn't an established channel to get some exposure to it. But going back to the liquidity thing, and this ties into crypto and ties into the tokenization narrative as well. Liquidity matters for collateral, collateral matters for liquidity. And one thing that tokenization can do is certainly unlock more collateral mobility, which will be good for liquidity overall. That's more a longer term play. But shorter term, I've been thinking a lot about what are the catalysts to the downside? What could drive the crypto market way down? And obviously the number one that I've been fretting about for most of this past year is the stock market correction. I've been worrying about the concentration at the top end. It's at record levels now, but I'm coming around to understanding that that's just simply how it is now. It's risky, but that is how it is now. It's a fairly manipulated market, so we don't have too much to worry about there. When that worry is removed from the downside catalysts, then we can just focus on some of the crypto specific ones, such as fraud. Very unlikely, given the scrutiny most of the big names are under now. Problems with Tether, perhaps. Again, very unlikely, because their capital base is very strong. Problems with Strategy, having to offload some of its Bitcoin. I don't think that would mark the market down too much, because again, it's got a fairly hefty cushion if it needs it. So again, what are the big downside catalysts now compared to what are the big upside catalysts? This has to be at the forefront of most investors' thinking as we head into the new year.
It's funny when I listen to you, you have your finger on the pulse of the market. So that's exceptionally right. The one you didn't mention is quantum. That's the actual only real downside catalyst. But once again, I think that's massively overblown. The Tether story, I said it yesterday. I have a lot of respect for Arthur Hayes. I've never met Arthur. I'd like to. I follow him. I read. I really enjoy reading his newsletters. He got that one either out of context or just way wrong. It's just way wrong. Tether is massively over collateralized, far better than any bank could ever possibly be. So I don't care. And the MicroStrategy stuff is total, absolute nonsense. You may not like MicroStrategy as a stock because you don't like its risk return profile, which effectively is it will always underperform Bitcoin in sideways markets, big time. Always. And that's exactly what we've had for a year. It will underperform on the downside slightly, but it's that time decay, the interest they're paying, that makes it underperform in sideways markets. And it will outperform in upwards markets because it is leveraged. Now, if you don't understand that, then don't buy it. But there is literally nothing on this planet that could force them to sell a single Bitcoin, over the next year and a half. Now, they might choose to, but if they chose to sell a single Bitcoin, it would be because their stock is trading at such a discount that as a corporate citizen, their need is to look, if I can buy Bitcoin cheap, it's the same reason, but it's not just them, it's everybody in the market. If you could buy MicroStrategy at a discount to its Bitcoin holdings, knowing that it will outperform in an upside market, it's a smart trade. And so, yeah, their corporate treasury might say, you know what, a stock buyback is good for our investors, and so we'll do that. That's not the kind of thing that will be large amounts of Bitcoin underneath it. There may be people doing that trade, but really, it's sort of like what happened with Grayscale. I loved buying Grayscale. I bought a lot of it. I started buying it at 35% discount. I bought it at 45% discount. I bought some at a 55% discount. And then I held it. And I watched, and it went to 55. It went back to 40. And then where did it go? It went to 0. Why? Because it could be convertible. Banks always trade between a 0.8, i.e. 20% discount to their book value, and 1.5, or if you're JP Morgan, 1.8. MicroStrategy is trading at around a 0.9 something now. If it gets towards 0.8, yeah, people will buy more of MicroStrategy stock and sell some Bitcoin against it. But that's not going to be enough to move the market. It's just the way it is. And oh, by the way, the bank analogy makes sense because you probably covered this a couple of weeks ago. I think you did, when the chairman of the Basel Committee said that crypto they have to rewrite the crypto collateral rules. That is not a small deal. Because what you just said, and it really matters, people don't understand this. Once Bitcoin can be used as pristine collateral inside the financial system, owning a hoard of Bitcoin that one can use to create financial products, to hypothecate within the system in a transparent manner, turns MicroStrategy's Bitcoin holdings into a cash generating holding if they're smart. And that is exactly what Saylor said yesterday. And people missed it. So becoming a Bitcoin bank is where that's going. So all the FUD is crazy. But you're at market bottoms as well.
Yeah, exactly. But once we, hit at what we think was going to be the bottom of this current ennui or malaise that we're in, and once we accept that there are no major downside catalysts, we have to start looking at the upside catalysts. And Bitcoin has something going for it that no other asset in liquid markets today has. And that is most investors are still not exposed. The big money is not exposed. You follow the Bank of America Fund Manager Survey, 7% of respondents have exposure to crypto. That's a lot of new money to come into the system. And what drives bull runs? It's new money, always new money. Compare the amount of new money that could come into crypto, Bitcoin, let's say, is the main on-ramp, to the amount of money that has yet to go into gold, or even the amount of money that has yet to go into some of the AI plays or other equities. It's the new money that will, I think, make 2026 a much better year for Bitcoin than for all the macro assets that have outperformed it in 25. So
yeah,
again,
I think you're bang on there. And that new money matters because look at the relative size. I mean, today gold is flying again, right? So we're at 42.57 or whatever. Silver is over 59. So, there is a hot ball of money that is flying at silver. I personally think silver has a real shot at 75 and gold at 5,000 before this rally is over for a bit, before there's a pause. But we'll see. I mean, I'm more bullish on it than most. Mostly because of that momentum play, because of all the people who are trading it. But we could talk about price all day long, but there are a couple of other topics that I really want to delve into. You did a really good job this morning. I'm going to pivot to stable coins. And I think that it's really interesting because people think there's no market impact for stable coins. Understand that throughout the crypto ecosystem, you have both Tom Lee saying Ethereum is dependent on stable coins. That's where its growth is going to come from. And you have the XRP army talking about RLUSD taking over the world and making somehow the XRP token worth more than all the banks that are using it combined, because that's literally what they think. I mean, seriously, they literally think that the token that they think will dominate in stablecoin use will, even though it's a commodity, even though it's based on the fact that it should be cheap and easy to use, they think it will be worth more than the market cap of the entire European banking sector, for example. And I mean, that's quite what they say. And then they say, well, math doesn't matter, market cap doesn't matter, and other stuff. But you made a point this morning, which I thought was brilliant, about Sony. And I think you should talk about that, which is that, well, wait a minute, won't firms actually either build their own technology, or if they do use other pieces of technology, make sure that it's cheap and port them over to other technologies if for some reason the blockchain they're using gets expensive? So I think you should talk about that, because I think it was a really interesting story. And there's all sorts of dynamics vis-a-vis the banks that you talked about as well, foreign versus US domestic, etc. So I've teed you up to explain it, but I think it's a really important story with lots of implications for the crypto market.
Awesome, David. Thank you very much for that setup. It is a topic that I love getting into the nuts and bolts on, because that's where the juice of the story is. Stable coins, yeah, not much everywhere. Everyone's talking about stable coins. But when you get into the nitty gritty, it's a much bigger transformation to finance than anybody seems to realize. But rather than focus on that, let's focus on the market impact, as you suggested. And here we have Sony issuing a stable coin. The release did not specify what chain it would be issued on, but it's probably not a stretch to assume it will be on Sony's own blockchain, because after all, is that not one of the reasons they built it? And then we have not just the blockchain angle, but we have the ecosystem angle. Sony is a sprawling multi-conglomerate. It'll probably not surprise your viewers to learn I'm not a gamer, but I do understand the power that PlayStation has. And when you can enable in-game transactions, microtransactions even. What about in-game DeFi, where you have decentralized asset swaps, or maybe lending based on your avatar or something like that? This is opening up an entirely new application for stable coins, not just the trading that we all know and love. That's been the main use so far. Not just the cross-border transfers that we hear about every single day, and that is getting TradFi interested. But here we have a much broader potential application of engagement, of ecosystem development, and of innovation in the user experience. And you're so right. The fact that they will probably be able to pull this off within their vast, sprawling property network is because they do have total control over their blockchain. We saw similar developments with the Tempo announcement from Stripe. Again, they want control. Circle is building Arc. It wants control. There are many others. I could keep going down the list. And obviously, this race was started with Coinbase launching Base, which is becoming a healthy ecosystem unto itself. Now, I get pushback when I float this theory from the saying it's too complicated. We all want to be just on one network so we can all transact with each other. And what they don't understand is that bridging technologies in connectivity is advancing fast. And so the sprawling confusion that people are worried about is going to be abstracted into the background. And all we're going to get is utility, new types of utility. Blockchain recedes, utility moves forward. And yes, those blockchains that have sold themselves on connecting the world and stablecoins, the ones you mentioned, they're probably going to have to find some other way to stay relevant.
Well, I mean, I like a simple analogy. Copper is important, right? Fiber optics are important. But are the cable manufacturers or the copper miners worth more than the financial system that is powered by the wires that connect all the financial centers? The answer is no. And so when you use the word utility and people use the word utility, I hear an asset that will have value, but its value is constrained because it cannot become more expensive than other forms of utility, which are cheaper, i.e. it's a hyper-competitive market. And in the world of crypto and a lot of blockchain technologies, people are talking about them as if they can go to the sky. Now, that doesn't mean it can't be bigger than it is today. In fact, one could argue that the crypto ecosystem is woefully undervalued based on the materiality of the overall infrastructure that it will be. And just to level set, when I talk about the overall crypto infrastructure, I'm talking about Bitcoin is off to the side. Bitcoin is a digital gold value narrative, base layer narrative. All the other blockchains have to be dealt on utility.
I'll keep talking while Dave is temporarily off screen. Utility. I'm not quite sure where I'm going to go with this, so I'll hop over to focusing on the names that we have been talking about, the abstraction of blockchain into the background. In the end, people don't really care what rails they're using. They just want, give me my experience. It's
exactly. Yeah, the point that I was trying to make before I got interrupted was that utility is going to drive value, and eventually people will own tokens because the tokens themselves, like, we'll pick an example where there's clear utility, BNB, right? So, Binance creates a token. The token gives you cheaper rates on their exchange, which is highly in demand. It gives you utility within an ecosystem that is being used, and they are taking the profits that come through it and burning the token to make it more and more scarce. And as it gets more and more scarce, there's value. And so you can, whether or not it's from buybacks, which are how quite a few of the stock markets work, right? There are lots of stocks out there that don't pay dividends. They just take the money and they buy back stock to make it more scarce, and you have a piece of the action. So you can see that. Now, under Gensler, what people don't understand is that you more or less couldn't do that without him calling it a security and therefore plunging it into a no-go zone, because the securities rules do not apply or do not work for tokens. Now, Paul Atkins, his successor, has said, I understand that. And so the other piece of news that's come out, which is a huge piece of news, is he's saying in January they're going to start giving exemptions for innovators. And what does that mean? Well, that means that a token, and I'm not going to name names because I don't talk to any of them, but let's say you are a token issuer and you have a governance token. You can vote yourself if you're the issuer and you control it, and you can set up for a vote to be able to pass through dividends to token holders. And all of a sudden, you can apply for that through exemptive relief to be able to do that without being considered violating securities rules. These are the sorts of things that are going to happen. And so you're going to see this trend that has already started towards tokens that have a path to value to token holders will go up there. So if it will go up, the days of pure memes in crypto are going to come to an end over the next 2 or 3 years. It doesn't mean memes won't work, because memes with communities might very well be able to monetize. I mean, I'm not going to pick one. Well, let's pick one. Pudgy penguins. They're a marketing thing. They are used, in commerce. There are ways of monetizing these things. But the point that layer ones, layer ones have to have a niche. You're going to need to, if you want to invest in Solana, and I own Solana, you have to believe that it can power an ecosystem that is much bigger than just memes. And I think the answer is it can.
So you're talking about chains that don't really have the utility and therefore can be considered memes. They sell on their brand versus the actual meme stocks, because again, I'm going to push back that I don't think they're ever going to go away, because people are people. We like it. We enjoy it.
That's right. Yeah, exactly. I'm not saying they go away. I'm not saying that they won't do badly. What I'm saying is markets are going to start valuing ecosystems and tokens and layer ones based upon the revenues that ultimately can accrue to token holders one way or another.
Because we're sort of done with the talking now. Give us the utility. It's been years of talking. Now we actually want the results. And as we were saying before, the blockchain gets abstracted. I've always said we'll know that we've arrived when we're not talking about it anymore. It's just a technology that we use, which reminds me of my favorite Douglas Adams quote. I know we have to wind up, so we can wind up with this. And that is, everyone keeps talking about technology. What we really want is stuff that works.
Yeah, I love my favorite. My favorite Douglas Adams quote is probably "Don't panic," but that's okay.
Yeah, we're way past that, right?
Yeah, I used to do put the Hitchhiker's Guide to the Galaxy behind me on down days because it makes people people get crazy. But I mean I think I do want to get back to one thing. So when you talk about macro and you talk about crypto, people always talk about, well, what does that spending do? And we assume it. But you mentioned Europe going into the military. We understand that people talk about fraud in the US and, oh, they're going to be able to cut budget deficits, and Trump talking about no income taxes. What's actually happening is all governments around the world are spending more than they're taking in. And so the question becomes, what's the governor, and where does that money go? And when the money goes into the economy and you get it into people's hands, they spend. What they don't want to happen is for more consumer demand to push up consumer prices, because especially what happened in the pandemic when supply chains were tight and they gave money to consumers, prices ballooned and we had 10% inflation basically. They don't want that, but they're happy for the money to go into the economy and to go into investments and make assets go up so people feel wealthier. Now, there's pathologies with that, such as homes becoming less, harder to afford, etc. But that seems to be a global phenomenon. I mean, you see it happening in Japan now. You see it certainly in Europe, and God knows in the United States that it's all out. To me, that means risk assets are being priced differently than they used to be. And so you said, well, I'm not as worried about the stock market going down. I'll tell you, I always worry about it. But corporate profits have gone up as a percentage of GDP as fast as the stock market has gone up vis-a-vis GDP. Because what we have is an environment where companies are making more money. And when companies are making more money, their stocks are more valuable. So that's the reason why I'm not so worried about it. But I'm not sure that's sustainable in the long run, although AI would tell you that it probably is. So it's an interesting question. I'm curious how you look at those cross currents, because that, to me, that's the largest thing. The old relationship between, in terms of valuation metrics or, stock market to GDP would tell you that you think we're going to fly off a cliff. I personally don't see that, because corporate profits have moved as much as, in fact, on some valuation metrics, markets are cheaper than they have been at various other times in the past.
Yeah, and we forget that there are many levers to help companies make more money. And one that the administration is currently working on is regulation. Remove some of the regulations. We're starting to see some discussion of this in Europe. I mean, maybe, I doubt it, but still, regulation is a lever that is very overlooked in making companies more profitable. Not necessarily involves downsizing the government, but that's a whole different discussion. The macro spending is basically, the genie's out of the bottle. In the pandemic, I think, was systemic in that, a very before and after moment, and that we saw that modern monetary theory that we all used to laugh at kind of holds these days. We still laugh at it, but how different is the modern monetary theory from what we're actually living through now? We know deficits are bad. We also know that no one's going to bring them down. No politician could get elected on doing what needs to be done. And it's a question of, the train, Lynn Alden's saying nothing stops this train. My fear is that eventually the train will run out of tracks. And that's when you really want to hold, Bitcoin and gold, because who knows what's going to happen then when governments find that they simply cannot outrun a global exit. I don't think that's anytime soon, though, because there's still a lot of matches in the box, a lot of firepower that they can throw at these things. And when it all falls apart, that's going to be a very bad time for everyone. We've always known, though, Dave, that when Bitcoin hits 1 million or whatever, it'll be because things are really bad out there.
Yeah, I mean, I actually don't think that Bitcoin hitting 1 million requires things to be really bad out there. I think that it requires the network to grow. I mean, the chart that I always come back to, and it's bog simple, but it's very, very straightforward, is the hash rate chart. And so, I look at this and on a constant basis. And so when you look at it, here, I'll show it to you because you'll see exactly what I mean. Where are we? So this is a very simple chart. if you look, this is can you guys see the screen? Because I can't tell right now. Can you see it? Right. So when you look, you see that, and it's really impossible to see back here, but it did this too. So in every other cycle, it went the hash rate at a point in the halving, it got cheap, i.e., the Bitcoin price, which is the black line, underperformed the network. They changed the block reward. There was all this fear that it was not going to survive. It then proceeded to catch up. And then you get this euphoria phase where you get above it. This one was to the 17,000. You see here, it went well below, and it's not a small number, right? In terms of ratio, you can see the number goes below. It stayed that way for a while. And then once it became clear the Bitcoin network was going to continue to grow, it went way up. And then what happened? China ban, bang, crushed the network. You almost can't see it anymore. It's so small, but you could see the incredible correlation between the twin peaks, right? The 60,000 or 61,000 here. China ban happens. It goes all the way down to 32. And then people talk about, well, look at the miraculous rally back to 69. Well, what happened? Well, what happened was the network started to grow again. And then people were like, okay, the euphoria popped. Then we had Luna, Voyager, Celsius, FTX, bang. Then for a long period of time post FTX, as we were in the FTX malaise, it stayed below the market and then eventually caught back up, got there, came back down again, at the end of Biden. Then Trump gets elected. It goes to here, but it never really gets to euphoria. And then, kind of falls back below, catches back up, gets a little above it, falls back way below. And now, right now, we are at the cheapest it's been in its history, which, if you're looking at the strength of the network, you kind of wonder why. And there's all sorts of wondering why. They're wondering why is we just had a government shutdown in the US and a big liquidity suck out of the market. And there was fear of it happening, and it did happen. Well, now you're talking about liquidity coming back. So what does that mean? Liquidity comes back, and you're going to get back up to that blue line. And the question is, will there be the tailwinds to create a euphoria bubble now, or will still bounce along? I don't know that. I just know at some point it will happen. I don't know when. It could be in 2026, could be in 2027, could be in 2028. I don't know. You zoom out and you can see as that blue line continues to grow why and how there is a scenario for Bitcoin to get to exactly those sorts of levels without catastrophe, but it takes time. Bitcoin at that level in the next year means there's something really horribly broken. You're right. Bitcoin within the next 5-10 years, not necessarily. That's the difference.
Yeah. And I know we have to wrap now, but I'll push back on the hash chart. It is interesting to keep an eye on, but there's cause and causality there. It goes up when the price goes up. Because of the price going up, more miners come in, it's more profitable. It'll go down when the price comes down because of the price going down. And again, there's some circularity, it's reflective, but I don't think that's going to be the driver for investment going forward now that Bitcoin has become a macro asset.
Yep. I think that is a good place to wrap. I think that's where we're sitting. I'm sorry for keeping us over time. I actually thought that we went longer than we were scheduled for. So sorry about that, Noelle. I didn't mean to keep you glued to the screen by
fascinating to talk to you. I could talk to you all day, as you know.
So anyway, we will be back tomorrow, I think, or if not Friday. And for those who want to listen to Crypto Town Hall, that will be at 10:15 this morning as well. Here we are. We're back at 93,000 again. So as we were talking, the market basically stabilized, and who knows where we'll be. But it will be interesting. That's what the one thing we know. Volatility in Bitcoin is back.
Yeah. And we can appreciate that we are never bored.
Never bored. So with that, stay safe out there, everyone. We'll see you next time.
Today's video is sponsored by Rain Protocol, a decentralized platform for prediction markets where you can wager on future events without a central authority. It's built on Arbitrum and supports markets for everything from major global news to niche topics. The platform uses an automated market maker to dynamically adjust prices and maintain liquidity as participants place wagers, ensuring markets remain balanced and active. Anyone can create a market with a minimum of $10 in liquidity, choosing between public markets open to everyone or private ones that require a code to access. A standout feature is the resolution process. Public markets can be settled by Delphi, an AI oracle that draws consensus from multiple data sources for impartial decisions, or by the market creator. If a participant disputes the result, they post collateral. 0.1% of the market volume or up to $1,000, and the case escalates to human oracles for final review. Whether you're forecasting events, hedging risk, or creating incentives for specific outcomes, Rain offers transparent fees, no refunds on wagers, and a Rain government's token with a buyback and burn mechanism tied to trading volume. Visit their site or click the link right below to explore Rain Protocol.